Hello, everyone. For those of you that I know, thanks for joining to hear more about companies that I've been talking about for really since I started the fund. And for those of you that are new to Optimist Fund, I'm looking forward to pitching you about our top holdings and a little bit more about the fund, what we've been doing, where the opportunity we see is today, and just more about the fund. So just get to our agenda here. All right, so the agenda. I'm going to start off just to get it level set everyone of just a brief description of Optimist Fund, and then I promise to make that short and sweet, and then dive right into Carvana, Wayfair, Uber. Together, these three holdings make up 40% of the fund. And then we'll hop right into Q&A in case any of you have questions about these three holdings. Be able to address any deep thoughts that you have. I know several of you have sent me some questions already. So I'm looking forward to answering them. All right, so Optimist Fund strategy. So Optimist Fund is a concentrated global equity strategy. We focus very, very closely on a few things. We invest in 15 to 25 underappreciated market leaders run by exceptional management teams that have significant growth opportunities. So you'll hear me say this over and over and over again, because if there's like one line that gives you a good sense of Optimist Fund, what we do, the only thing we do, what we focus on is 15 to 25 underappreciated, so undervalued market leaders run by exceptional management teams that have proven track records that have significant growth opportunities. So they're not in the ninth inning of what they're doing. They're in the first inning, maybe the second inning, maybe the top of the third, but they're definitely not near the ninth. We focus on maximizing returns over a 5-year investment horizon. So I am not thinking what are going to be the best performing stocks over the next 6 months, 3 months, or 1 year. I'm thinking, what are the great companies that are underappreciated today that have significant opportunity to generate a lot of returns for my investors over the next 5 years? And importantly, and those of you that have been invested for the last 2 years will know, is that I embrace volatility. I focus on the areas that often are more volatile, because it's what creates really attractive risk reward opportunities that we can make a lot of money on over the next 5 years. So what makes Optimist Fund different? Really, it comes down to 4 things. Well, I'm sure there's more than 4, but 4 are the most important. Focus, first principles thinking, behavioral, and risk management. So focus, as I said, 15, 25 holdings. Our top 10 ideas today is 80% of the fund. It will likely always be over 50% of the fund. So as you think, 80% of the fund's 10 holdings. Today I own 19 holdings. So you got 80 and 80%. I have 10 holdings, average weight 8%, obviously. And then 20% of the fund is 9 holdings. So those are all much, much smaller positions. So really there's 10 companies that I am very, very close to, know deeply, and think are exceptional opportunities today. And then another important consideration is a lot of investment products are they do many different things. They look at their fund and they say, this is our compounders bucket. This is our special situations bucket. This is our dividend payers bucket. They kind of have these little sub buckets within their aggregate fund. That is not at all what I do. So I'm very focused on one type of company, and that is underappreciated market leaders run by exceptional management teams that have a lot of growth opportunity. If you were to compare me to an auto OEM, I would argue a lot of funds are like GM or Ford, where they have a lot of mass market vehicles. They got, they have a lot of different cars, a lot of different styles. They do have a few high performance cars. Ford does have the Ford GT. They stopped making it, but that is a beautiful car. I'll give them credit. But I like to think of my fund more as like the Ferrari, where we're only focused on high performance companies, and that is where we put all of our focus. And then we have our defined market, which is global developed markets, and a mid cap skew. So I focus on 500 million to 50 billion market cap. The first principles thinking, probably the most important differentiating feature about the fund, is that I always think about every investment opportunity as if I own 100% of the business and its financial statements was my checkings account. And so what do I mean by that? There are a lot of businesses that could have really, really high profits. They could look like great businesses in the income statement. But then if you looked in the cash flow statement, they have less money flowing to them every year. So they looks like they're making a lot of money, but if you actually owned the entire business, you wouldn't have more money in your bank account. Conversely, there's other businesses where you could have more money coming into your bank account, uh, but it shows that you're not making money. And the reason for this can often be because of how investments are deemed in the financial statements. And so a lot of companies that I looked at, or that I like, frankly, if you were to Google them and see what do people think about this business, you'd see a lot of reporters or articles about people saying, oh, they're unprofitable, low quality businesses. This is just irrational venture capitalists going after an opportunity. And of course, that's sometimes the case, but very often, these type of companies might be investing in something where the investment is just expensed immediately and it is not capitalized. And thus it could look like Uber in the early days. Why are they spending billions of dollars? They're losing billions of dollars. This is not sustainable. This is a bad business. And then now when we look in hindsight, it took a lot of money to build the supply side, all the drivers to be waiting around for you to order them, and the demand side. That took money to build both sides. And so that early period, they were investing a lot of capital that now is reaping a significant benefit. Independent research. Any of you that have followed some of my holdings, my largest holding is a company called Carvana. It has been one of the most shorted companies in the world, believe it or not. And so, given that I think of everything as just a business that I could own 100% of, and I really think from an independent perspective of is this an attractive business that can make us a lot of money, I can end up in areas that a lot of people might not like. But I always have that independent mindset of just finding what's the most attractive risk reward opportunity, and am very, very comfortable being very contrarian if it makes sense to be so. And then lastly, the business owner's mindset. Like I said, like I'm focused on creating wealth over the next 5 years. That's what I'm focused on. People could talk about a recession in the next 6 months. Oh, we got to get defensive in the next 6 months. Well, let's just own the best businesses that are going to be able to benefit from the recession in some way. They'll be stronger. They'll be able to take market share. And that when inevitably we're not in a recession, they're going to be bigger, more profitable, better businesses. It'll just create more value for us. So that is what I'm focused on. Then it comes down to behavioral traits. So I can say that I'm focused on the next 5 years, but really, if you're trying to maximize returns over a 5 year basis, you have to be willing to like lean into volatile situations. You have to be able to make decisions when a lot of people are selling stuff or people are getting scared about some sort of near term macro event or something. And that's something that we've been able to do a pretty good job of thus far. The last 2 years has been likely the worst small mid cap growth market in the last 20 years, probably comparable to 08, 09. And we had some crazy situations that I'm going to elaborate on with Carvana, where it was the smallest position in our fund at $128. Then a lot of things happened. A lot of articles were posted that I believe were false. The stock went all the way down to $3.50. We kept buying, averaging down. Bought more. Our lowest buy was around $7. Our average cost today is $30, and now the stock's $110, going to $750. And so this is really just evidence of how I think about things. Like in different scenarios of immense opportunity, like I'm really going to dig in to see how we can make the most money over the next 5 years. And lastly, risk management. So obviously the 50 and 25 holdings, like that's how we keep the shelf tight, and I can focus a lot of time on on a few names. One position will never materially hurt the fund. So the idea is one position could make a lot of money for the fund, but it's definitely not going to make the fund. And without question, one position cannot break the fund. And that's frankly just 15% max at costs. If it gets to over 20%, we'll cut it back down to 15% at the end of the month. And ultimately, we want to create a lot of value through getting 60% of our names really right, and it be spread across several names and not just be one name is successful and 19 others are not successful. That's not the strategy. The one important element that I think gets not enough attention is put towards is the focus on downside as well as upside risk. So every name that we look at, we always have a downside target as to over the next 5 years, what does bad look like and what kind of returns would we generate if this scenario occurred over the next 5 years. And so we always have that, like, everything is a probability. What does good look like? What does bad look like? What's the risk reward trade-off there? But then upside risk is really important to focus on. And that is if my target is in fact way too low, and the stock goes from, let's say it stock's $25, I think it's worth $75. And over the year, it goes from 25 to 75. And I'm like, awesome, this was great. Pat myself on the back. I think, Jordan, you were right. Awesome. Let's sell it, move on to the next thing. It's really focusing on upside risk for me is at that moment when I was right, is 75 right? Or actually, am I too conservative on this upside case? And in fact, this could be a $300 stock in 3 years. And so really stressing that, like, getting the upside right is very important to optimizing for our returns, as well as the downside is how we can get those like asymmetric payoffs. Like, for example, like, Carvana goes from $4 to $50 and not selling a ton at 50. And then it goes to $120 and you still get to capture that because you know it so well. And you understand that now that it's gotten to this point, the upside now is like way higher because a lot of the risks that you were concerned about previously have actually dissipated dramatically. And so we've been in business now for 2 years and 2 months, and it's been an insane 2 years and 2 months, as if you follow business or follow the economy would know. Over this time period where the fund is roughly flat, and that started with a bad 2022, and then us doubling down on the positions we had conviction in, and having a really strong 2023, and now a good start to 2024. I'm definitely not satisfied with being flat over 2 years. That's not. I don't do this. I don't, have put so much focus into a few names and obsess over finding out these asymmetric opportunities so that I can be flat over 2 years, evidently. But if we actually like put it into context of what's happened, I'm actually quite pleased with the fact that we've been flat over this 2 years, given what has happened. And I think now we've kind of gotten through this almost like battle moment, where a lot of our businesses have been like battle tested, have way better margins, have better market positions, and are now like on the other side of this, that is going to reap significant benefit over the next couple of years. So the fund today is 19 holdings. You can see this is across the top 3 we're going to talk about today: Carvana, Wayfair, Uber is 40% of the fund. Then obviously it goes down after that. Always have a downside target price, an upside target price. And as you can see, I think we're going to make a lot of money over the next 5 years. 2022 was a very ugly period for a lot of companies. Believe it or not, it's still very ugly for a lot of companies. Other than NVIDIA and like several other large cap companies, there is a lot of opportunity in small mid cap land. And I am extremely excited. All right, so now that we got through me introducing you to the fund, let's get to the fun part. So what we will discuss: Carvana, Wayfair, Uber. I had a conversation with someone recently, and they had been following things I've been saying about Carvana. And then, frankly, what I realized, they're like, well, why is it so special? Like, what's special about it? So I kind of realized, let's bring it back to basics. Why do these companies exist? What's our thesis? What has happened? And what's the path to us making a lot of money? This is an awesome Carvana flatbed, and that is a car being delivered to a customer. All right, why do they exist? So Carvana provides a better way to buy and sell used cars. There's three components to this. There's the buying experience. So I don't know how many of you have bought a used car before, but generally you go on AutoTrader, you search for a vehicle that you probably already know that you want. You find the one that has the price, the features, the color that you're interested in. You see it's at this dealer XYZ, and you say, oh, let's drive there. And so you drive there, you go in, there's a sales guy, he comes out, he says, oh, how can I help you? Oh, let me try out this Ford F-150. They get the keys, you drive it around, you say, great, this is what I wanted. Let me buy it. All right, let's start paperwork. Then you go into the back office, you start all the paperwork, the finance guy starts selling you stuff. Brings you to that back office, you're waiting. He says, well, have you thought about getting a warranty on your leather seats? And you start thinking to yourself, am I getting screwed over right now? And then you go through a couple hours of just constantly thinking, should I do this or should I not do this? And it's generally an experience that people do not like. Some people love it. It works for some people, but generally speaking, people don't like the purchase funnel of buying used cars. And Carvana realized that. And so in 2012, the CEO and a few of his friends started this business, which was the idea of, let's be able to buy a car. Like, we buy stuff on Amazon, we can search online, we can fill out all our information to pay for it, and it can just be delivered to your house. And if you want to keep it, now you pay for it. And if you end up not liking it after testing it out for a couple days, they come pick it up and return it to you. So they started this in 2012, and people loved this experience. The fact that it was all online, you can do everything like on your phone, like you buy everything else. The home delivery, 1 week return policy, so convenient. And then also you could sell your car to Carvana. So like right now, I could, if we lived in the States, you could go on Carvana, type in your VIN, type in a few details about your vehicle, and in 2 minutes they'll give you a bid for your car, and then come pick it up within the week, hand you a check, or e-transfer you a check after they confirm the vehicle that they're picking up is in fact what you put in. Like, that is so convenient, seamless, and that's why people love it. That experience piece is critical. Then you go to selection. They have massive scale. They have 30,000 cars on their website currently. The average dealer has less than 200. And then value, because of the scale they have, they are able to take a lot of middlemen out of the value chain, which on average saves consumers about $1,000 per car. So it's very similar to like what Amazon brought to like general merchandise e-commerce. Carvana is bringing that to the online to buying used cars. So the investment thesis, and you'll see a commonality with every company I look at, it's for the investment thesis is going to come down to 5 points: exceptional management team, enormous market opportunity, wide moat due to significant competitive advantages, attractive unit economics, and an attractive valuation based on the cash I think the business is going to generate over the next 10 years. Key point there. It's not the valuation they're generating this second. It's not the valuation they generated last year. It's, what is this business worth today based on the cash I think it will produce over the next 10 years. So Carvana's management team is incredible. This is Ernie Garcia. Ernie Garcia the third, actually. His dad owns a company called Drive Time, which is a brick and mortar car dealership that has about 100 locations. So his dad is very, very wealthy. And he grew up in the car dealership business. And when he pitched his dad the idea of seeding him to start Carvana with a few of his friends, these friends right here, he did so. And this team together, so they started in 2012, first market Atlanta. Then Mark Jenkins, the CFO, joined in 2015. He actually went to Stanford with these other three guys as well. And then Dan Gill joined in 2015, also went to Stanford with these guys. So these guys are very, very tight. This is like a management team. This isn't a management team like you'd see at a bank, as you would imagine. This is not a bunch of people coming together and saying, "Oh, let's professionally like earn a paycheck." These are five people that had an ambition to become the largest and most profitable used car dealership in the U.S. Um, after being in business like 3 years. The ambition is pretty insane, but the execution has proven to be incredible. So we think about alignment. Ernie and his dad own about 40% of the company, so they have about $10 billion of equity in this business. The CFO has about 1 million shares. The stock is currently $110. So about $110 million worth of shares, and he also has another about 50 million in options. And the same can really be said as like similar figures for each of these guys. So all of these guys have made about 100 million bucks, and then obviously Ernie has made him and his family about 10 billion. But the opportunity ahead is so enormous that these guys could uh, just become some of the wealthiest people in the world, frankly. So let's look at the market. The auto market is enormous. It is a huge market, and pretty much anywhere you live, like anywhere you grew up, whether you grew up in Toronto or some small town anywhere in North America, probably one of the richest people in your neighborhood was the local car dealership. There is a lot of car dealerships, and they make a lot of money. And it's very, very fragmented. So if you look at the used car industry, like it's an over an $800 billion industry. I think it's the second largest retail industry. It's incredibly fragmented. So the largest used car dealership is CarMax, and they have 2% market share. So there's a lot of dealers. And in general, it's been a very similar customer experience for a long time. And so there's a lot of room to innovate and steal market share. The competitive advantage for Carvana is really what is why this business can become so valuable. They have raised $10 billion to build the business they have today, which at scale, based on this $10 billion, will likely produce about $8 billion of annual profit. So they have like invested so aggressively to build something that is going to be enormous. And so to compete, to be able to do what Carvana does, to be able to have a national consumer brand with a proprietary finance platform where they, in fact, securitize the loans, to have internally the logistics, so all the delivery of cars going to people's houses and to going to different middle mile drop-off points is all internally. The reconditioning centers, so when you buy a car to do paint, dent, cleaning the car, like all these little repairs that you do when you buy someone's 4-year-old car, like it's not in perfect shape, so you got to clean it up a little bit before you sell it. All of these things they built to sell millions of cars, millions. So people looked at what they did and said, this is insane. They're investing so much capital. Is this going to work? And what we've seen actually is that we have a lot of evidence that it does. But the point is to recreate this, like, even if you are a family that's worth $100 million and has 7 car dealerships and has been doing incredibly well for the last 50 years, and you're the richest guy in your neighborhood, you're not going to compete with Carvana. Like, it's not a viable thing that you're going to think to do. And so this puts them in such a rare position competitively. And so then what's been the debate? The debate here is that they are spending all this money, and what's the returns? Like, does it make sense? If you were to Google what have car dealers said about Carvana, they would just, for the most part, trash them. And if you look at this and you just looked at it at face value, you'd say, oh, okay, so they've been losing money every single year since going public and up until 2021, but good improvement. And so what needs to be understood here is that Carvana, when they start in one market, And then they have to scale that market. So they have to spend a lot in advertising to get brand awareness so that people come to the site. They need to spend a lot in terms of like building out their physical infrastructure in that location because you actually have to pick up cars, recondition cars, and then move cars. So there's a lot of investment that needs to be done before you actually sell any cars. And so that front loaded investment comes up as a loss. But then as they scale throughout a market, they start making quite a bit of money. But since their ambition was to be the largest national player and not just the dominant player in Atlanta, they would take the profits from Atlanta and then open in Charlotte, and then open in LA, and then open in Phoenix, and open in Dallas, and they just went across the United States and continuously expanded. And so that's why you continuously saw losses, but you saw operating leverage. And you saw that operating leverage because the core unit economics, like the health of the markets they would open up, were actually making a lot of money and scaling. And so you can see here, like a cohort is a market they opened in a given year. So 5 out of the 9 cohorts had positive EBITDA margins. The 2 oldest were greater than 4%, which is roughly in line with like a lot of um, traditional used car dealers. So like they, in some of their oldest cohorts where they were still growing 20% plus, they already had a margin structure similar to like the mature players that have been in the industry for decades. So it's very clear that the economics were very nice. So now, like, why did this become an amazing investment opportunity? So 2022, perfect storm. Interest rates went from 0 to this. Car prices skyrocketed. They were expecting to grow 50% plus. All of a sudden, they realized that was not going to happen, and they had way too much cost. So they had to cut a dramatic amount of cost. Everyone started to get very much freaked out about that. And at the same time, every growth equity security, everyone was freaked out about. So the stock was going down pretty aggressively, and investors were scared. But at the same time, they announced to buy a company called ADESA, which is a wholesale car auction. They auction cars that other dealers will buy for 2.25 billion, and they were going to raise 3.25 billion. Use the 2 to buy ADESA, and then use 1 billion to actually add a lot of capacity to ADESA so they could eventually sell millions of cars. This is a deal they wanted to do for years. They were not able to do it years prior because ADESA was doing very well. But in 2022, the wholesale car auction business was a nightmare. It was doing horribly. So all of a sudden, the owner of ADESA was like, I'm willing to sell. All of Carvana's shareholders, for the most part, said, please, please do not buy this business because you already have to do a cost restructuring, and the market is just not the time to start adding more complexity. But given the Garcias own over 40% of the company, and they own super voting shares, they said, we understand your perspective, but this is a once and like we got to do this. This is going to be very attractive. We might take some pain right now, but we got to do this. And so they did it. Stock went from $200 really to $3.50 because people then eventually thought they were going to go bankrupt, which I never believed. But it went through this crazy, crazy period. But they kept saying what they were going to do. We're going to right size the cost structure, get the unit economics back to being strong, and then scale the business and get back on our way to becoming the largest, most profitable car dealer. So they did that. You look at 2022 to 2023, they shrunk the business, but exploded margins. They just got way, way more efficient. And they also restructured their debt to make people less concerned that they were going to go bankrupt, and to make it so that they were free cash flow positive and had a little bit more wiggle room. So 2023, then people realized, okay, this business is actually not going bankrupt. It's actually profitable. Like there's an economic machine here that makes sense. And that's what made the stock go from $4 to $55. But now 2024 is the year of inflecting growth. And this is like the exciting moment where we get back to Carvana being viewed as like one of the best companies, I think, out there. Q1 of this year, they grew revenue 17%. They had 7.7% adjusted EBITDA margins. That is the highest. So they had the highest organic growth and the highest EBITDA margins of the entire auto retail industry. 18 months ago, people were sending messages saying they were going bankrupt and that the model never made sense. And now they have the highest margins and are growing the fastest. And mind you, they said this the whole time and walked everyone through the cohort math and the details as to how they're going to get there. But no, everyone abandoned them. and now they've just turned it around and delivered exceptional growth. And so from 2023 to 2029, this is going to be the reacceleration to them scaling at incredible margins, which is why I believe this is going to be one of the best performing stocks in the world over the next 5 years, as they go from 300,000 units to over 1 million units at very high incremental margins. And I think it's going to make us a lot of money. All right, I'm behind schedule here, so I got to speed this up a little bit. I apologize. I love talking about Carvana a little bit too much, probably. All right, so why does Wayfair exist? Many of you have probably bought from Wayfair, but very similar to Carvana, except I would say it's a little bit less on the price side and a little bit more on the selection. So since Wayfair does not own inventory themselves, the real value add at the beginning was if you go to a brick and mortar store, there's only gonna be so many couches you can look at. There's only gonna be so many pillows. You're not gonna go to a store and they're gonna have 100,000 pillows. It's just they would never hold that in inventory. But if you aggregated every pillow manufacturer in the world and said, hey, you should advertise on our platform and we'll send you orders that then will get delivered to customers, that could be something that would be interesting. And so that's what they did. They just aggregated a huge amount of supply, merchandised it in an effective manner, and then marketed against it to get people to the platform. Then they went a step further and they invested a lot into logistics, which made it so not only do they have the best selection, is that you can get it fastest. So if you were to buy a couch today at a local store that you go to, you're probably looking at 6 to 8 weeks until you actually can sit on that couch in your house. That's really annoying. And frankly, I'm sure many of you know the stories where you're like, okay, 6 to 8 weeks, whatever, we can wait. And then it's like 3 months later and you're like, I still don't have this couch. This is incredibly annoying. So Wayfair is able to do much better than that. So typically on their like larger parcel items, it'll be 2-week delivery. On smaller parcel items, it'll be like 2-day delivery at tops. And so this is an incredible value add to people, and it's what's driven Wayfair to be a 12 billion revenue company. At the same time, they are they don't try to be the cheapest. They try to have inline pricing with significant selection, and a good shopping experience. So they do have value because they have like every price point you could look for, but they're not trying to be like, hey, you could buy this brown couch at Walmart for this price. You'll always get it cheaper here, because frankly, there's with an unbranded category, the actual like for like comparison becomes quite challenging. The investment thesis, as you'd imagine, is the same. Exceptional management, enormous market opportunity, wide moat, attractive unit economics, attractive valuation. As you can imagine, I was able to make this slide very quickly. Exceptional management team with aligned interests. This is Neeraj Shah and Stephen Conine. They founded the business in the early 2000s. They actually founded another business in the mid-90s. They went to university together at Cornell. They started an IT service company in the mid-90s, sold it in 2000, and then in early 2000 realized that there was a lot of search interest for different home items and not a lot of ability to buy those home items online. And so they started websites like birdcages.com or nightstands.com. And over the next 10 years, they built a $500 million revenue business, and across like 300 different websites, bird cages, all these different home items with these like obscure names. And they built a good business. Didn't raise any external capital. It was all, so they owned 100% of it. And then eventually they were like, okay, we should consolidate all this and like create like the one-stop shop for home and build out Carvana. And that's what they really started in 2011 and have been building it since. I should also add, they own 25% of the company. So they are incredibly aligned with shareholders. They pay themselves 80 grand a year. And since going public, they have never issued themselves one single option, which is just like, frankly, they could have. Like, I wouldn't have complained if they just did like in-market compensation. But the fact that they didn't just shows how shareholder friendly they are. So the home category is an enormous market, as you would imagine. And it's about 25 to 30% online penetrated today, likely can see its way to 50% penetrated. Like Wayfair today is a $12 billion revenue company. Their addressable market's $800 billion today. That grows at a GDP rate. So we're talking about a very large market. If you really think about like the online category as being 25% penetrated and the current market being 800 billion, you're looking at like a $200 billion addressable market today in which they have 6% share of. And so there's a lot of runway for this to become a very, very large company. The competitive advantage is really like matching supply and demand together. So since they don't own, that's a key differentiator between them and Wayfair. They don't own the inventory, right? So it's about aggregating a lot of supply and creating a great platform for that supply to be able to reach customers in an effective manner. And obviously, you can only reach customers in an effective manner if you're providing a value proposition that resonates with said customers. And so that's why the fulfillment piece of the business has been a value add to the suppliers because it allows them to sell more goods because the customers like it when they can get a good in a day or 2 days. And if they didn't take that fulfillment piece on, they wouldn't be able to do that. So they just keep adding to the moat by adding more services to make the friction between suppliers selling goods to consumers lower and lower and lower. This obviously costs a lot of money. They've spent $9 billion in advertising since inception. They've spent $2 billion in CapEx. It would cost billions of dollars to replicate what Wayfair has done. And might I add, they haven't actually made that much money thus far. They've been about free cash flow neutral because they've reinvested all the profits back into the business. So if someone were to go after Wayfair's specific category and try to do a Wayfair 2.0, that would mean they're probably going to be in about a decade to 2 decades before they make any money, which is a tough call right now. The unit economics have been really good. So the gross margins, it's a dropship business. So really it's like a spread between the supplier is willing to sell this couch at $2,000. Wayfair lists it at $3,000, and then they make that $1,000 and have to take care of the logistics and all the other component of the business. Obviously, advertising and whatnot is what gets that customer. But when they acquire new customers, these are called cohort curves. So they acquire a new customer. This is like a collection of customers. So you spend like, let's say $1 billion in advertising, and then you get 1 million new customers. And then over time, of those 1 million new customers, a bunch of them repeat, a bunch of them buy more stuff next year. Some of them buy nothing next year. 2 years from now, a bunch of other ones buy new stuff. Some others don't. So you kind of have this this curve of consistent buying behavior over time that you earn really attractive margins on, but they spend a bunch of money to first get those customers and then milk them over time, then use those profits to reinvest back into the business to build a large cash flow stream over time. So they've always had really strong customer economics, which is why they've only raised $2 billion to build this business, which is actually like quite, sorry, they've raised $2 billion, but they have $2 billion of cash on the balance sheet. So they've raised the amount of money just to have a cushion, but they haven't really deployed it all because they've been able to self-finance with just growing the business. And so it's a really efficient business that has been really underappreciated. And why is it underappreciated? 2022, perfect storm, very similar to Carvana. As you can imagine, 2020 was a great year. 2021 was less so, but still strong. 2022, all of a sudden the reopening really happened and consumer spending fell off a cliff. Now in 2024, we've had 2 years of double-digit declines in the home goods industry, which has put several furniture retailers into bankruptcy, made it so that Wayfair had to lay off people, get back to free cash flow positive. They did that in 2022. This was like the year where they had to fix all that. And then so 2023, we saw the benefit of that. So we saw revenue growth going from very bad to now growing again, adjusted EBITDA margin negative to now positive, free cash flow margin negative to now positive, everything going in a very good direction and getting ready for this inevitable return to very strong growth at very high incremental margins. So this period is like what we've been in. This period of like, this was a great business gaining tons of share, minted money during COVID, as you can imagine, but then kept hiring more people, assuming that they could grow off of that. They were wrong. And so they've had to fix that. That was a mistake they've acknowledged. And now we're back to positive free cash flow. They're actually growing the business when the industry is declining, so gaining tons of market share. And so once the home goods industry stops declining 10% plus, which is going to happen at some point, unless all of you decide that you want to stand for the rest of your life instead of sit on a chair, it's going to happen at some point. They are going to have a significant acceleration in growth that's going to come at very attractive margins. All right, Uber. I don't have a lot of time here, so I got to get going here. Uber. I'm sure all of you, well, actually, I used to think that everyone loved Uber, like the service, and now I've like met a few people that hate it for some reason, though they still use it. So I think it may just be like them liking to complain. But anyways, that might be one of you on this call, so I apologize. But so Uber has become this behemoth from just offering an incredible experience, as you likely know. If you have used a cab before, you know. I don't have to explain it. You know what the cab experience was. Importantly, the value had to be there on both sides of the marketplace. So they had to be a good service for the consumer. They also had to be a good service for the driver. Drivers had to be able to make an economic return that made sense for them to do the job. Investment thesis, as you'd imagine, great management, big market, wide moat, attractive unit economics, attractive valuation. Surprise, surprise. So exceptional management team. If Dara at some point decides to be the lead of Terminator 4, I think he might have a shot with this outfit here. But luckily for now, he's the CEO of Uber. So he was the CEO of Expedia for 12 years. Over that time, Expedia compounded at 20% annually. So it was a very, very successful business over that time period. He did a great job. Then he joined Uber in 2017 when it was losing market share to Lyft. And the CEO, Travis Kalanick, was doing a lot of weird stuff that many of it may or may not have been illegal. And so the board wanted someone new to clean up the business and take it to the next level. And that is what he has done. He also is very aligned. He has about $250 million worth of stock and options that have vested today, and he has another couple $100 million of value that will vest over the next several years, assuming he hits certain metrics. So he is incentivized. He's going to become a billionaire if he executes on turning Uber into a $250 to $300 stock price. So this is a massive market, surprise, surprise, and it's still not mature. Like you got to look at like the monthly consumer penetration. Australia, 20% of people use Uber on a monthly basis versus like Canada, it's just over 10. You look at all these different markets, like it just goes lower and lower and lower. There's a lot of runway still for this business to address more areas. Prime example is like, I don't know if any of you've used it, but Uber Reserve. Before, if you were going to go to the airport tomorrow at 4 a.m., and you're like, oh, I'll just use Uber. Well, it's like, what if you wake up at 3 a.m. and you go to request an Uber and there's not one there? It makes it so that Uber wasn't addressing that use case, and that's like a very common use case. So like creating products like Uber Reserve all of a sudden untaps like more market opportunity for them to go after. There's a lot of examples of this. Same with the Uber Eats business is that still the penetration of Uber of online food delivery is quite low. And there's a lot of runway for them to sell other goods and leveraging the logistics footprint of all these drivers. They can build a big business from that side too. The competitive advantage is enormous. As I gave an example earlier, like to recreate Uber is going to cost you at least $20 billion. In the funding environment today, where if you do not have AI in your name, you're probably raising negative $5. It's just no one's going to be starting an Uber 2.0 and trying to take Uber. Uber Eats, similar in food delivery. Now it's DoorDash. Uber Eats are really like the behemoths. They have that market. They're both very profitable, growing attractively. It's like an established Visa, MasterCard, very attractive market. And as you can imagine, once you build network liquidity where there's drivers and people, and the Uber business model is an app on your phone, and an app on your phone as a consumer, and an app on your phone as a driver, the car, Uber doesn't pay for the car. They don't pay for much, frankly. It becomes this amazing business. And so we've seen that now where they're really just like they've established their market position and now are just on the increment minting money on incremental growth. So the path to $250, less than obviously the Carvana and Wayfair upside, but still very attractive, is really them continuously growing in this mid-teen range while having a very nice profit flow through that's going to grow free cash flow per share over time. So they've really been on this path already. I would say Carvana and Wayfair are more inflecting currently versus Uber has been inflecting for the last 2 years. So it's more of a keep doing what you're doing, Uber, and this is the direction we're going. So to summarize, Carvana, Wayfair, and Uber had an extremely difficult last 3 years. They're now in the best footing that they have ever been in from a market share, financial, every perspective you could think of. They're in the best footing, other than valuation, frankly. Um, and there's just enormous upside. They own their markets. They are the leader. If anyone wants to go after their market now, it's like, okay, go through 10 years of hell to eventually hopefully be what they are now. They're not going to do it. So now is the time where we're going to see uh, the benefit of all the investment that's happened over the last decade, which makes me so fired up about the investment opportunity. All right, now to Q&A. We're 1 minute over. I think we're still going here. It hasn't kicked us out. If I don't know if anyone's left yet, but if anyone has any questions, I'm happy to take questions for the next 15 minutes, assuming this doesn't kick us out. Let me start it off here. What do I have here? Oh, okay, so given you are so bullish on Carvana, what is your outlook on the traditional store-based auto dealer business? Great question. So online penetration in auto retail today is a little over 1%, of which Carvana has about 75% share in. So, uh, so like how you should think about that is 99% of the market is people going to dealers in the way that they always have gone to dealers. And because there's like over 40,000 independent dealers, there's a lot of fragmentation and a lot of opportunity for dealers that focus on running stores to consolidate other dealers and generate a lot of attractive returns from that perspective. So what I would expect, frankly, is like I think that online penetration for online is going to go from like 1% to like 10 to 20% over time. And then the brick and mortar industry is going to go from obviously 99% to maybe 80%, but the 40-ish thousand dealers is going to turn into like 5,000 dealers over that time period. So I actually think there's a lot of acquisitive dealers that could create a lot of value over this time from just consolidating the industry. And so I don't want anyone to think that because I like Carvana, it makes them think that I think every other dealer is in a bad position. Okay, next question here. How do I think about downside scenario on Carvana? Good question. So the downside scenario. So first off, I think of the downside scenario as like, what is this stock worth in 5 years? So let's start off with like the downside is still me thinking about the fundamental value of this company 5 years from now. And so the scenario that I've played out is they today have capacity to sell 1.3 million cars. That's what they've built out in physical capacity to do. Right now, they're selling about 350,000 cars. They plan to sell 3 million cars in the future. So if I assume that all they decide 3 million, that's not feasible, but they just fill their existing capacity. So they end up selling 1.3 million cars, maximizing their current footprint, which might I add would result in less than 4% market share in the United States, which is less than their market share in Atlanta. So if you just look at like some of their markets, you look at Atlanta or like some of their older markets and see the market share curves, they've already surpassed 4% in many markets. But if we just assume 4%, like under 4% is the peak, they just monetize what they've built thus far, we're going to get to a point where they make about $1,500 per car, which is actually less than what they're making on the increment now, and go from 350,000 units to 1.3 million units. Suffice it to say, this is like way less than they expect to do and way less than they're on the trajectory to do. Like that downside case, I'm assuming 7% EBITDA margins. They did 7.7 in Q1 of this year. And this is a high fixed cost business that's I'm expecting to grow. So could the stock go down 20% tomorrow, or is it going to bounce around because of variety of headlines and whatnot? Yes, but over like a 5-year period, I don't see a scenario where we're under $130. And that's on the downside. Now, on the upside, I want to be clear too, is like 750 is not the best case scenario. 750 assumes they sell 3 million cars in 10 years. Yes, that's a really good number relative to 350,000 today, but there's 40 million used car transactions that happen in the US, 40 million. And when you think about what Carvana is building out, uh, if you get to 20% online penetration, that would be 8 million vehicles. And if they have 75% share of that, that's 6 million cars. So that's if they like, I'm assuming right now that 750 is based off of getting to 3 million cars. I'm assuming there's a scenario where they could get to 6 million cars and be significantly larger than they are today. And yeah, so let's be clear, like 750 is obviously that's great upside. They got to execute against that. There's a lot of growth, but this business could be like half a trillion dollar market cap at some point, and it's a $22 billion market cap today. All right, what else we have here? Wayfair. I have seen that Wayfair recently opened a store, and given that there's so much runway in online, does that not kind of prove there's less runway in online because they need to open stores? That's a fair point. Like it's actually a good point. They don't see it that way, and personally, I do not think that that means that there's less runway online. But I do think that uh, there's never a point where I thought that the furniture market would go 100% online. And so right now, as I said previously, like the market's 25% online penetrated. They have roughly 6% of that online piece and 2% of the aggregate market. And so if they can open stores and doing that is actually like it still resonates with their consumers, and they can do it in a financially attractive way to expand their addressable market and get more customers in a profitable manner. I think that makes a lot of sense. And I think that actually is going to happen. So if we think about what competitive advantages they have when opening stores, today you go to the Bay to buy a couch. Again, what's the benefit? The benefit is you're going to go and sit on the couch. Like you're going to be like, oh, okay, Wayfair, I could shop for a couch. Can't sit on it. Go to the Bay. I'm going to sit on it. Feels pretty good. All right, I'll buy it. Now you're going to wait 8 weeks for that couch. Wayfair, by having a store, they could have a showroom of couches. So you get the benefit of sitting on the couch, but now the delivery is a week. So I actually think, we'll see. It's still very early. They opened their first store less than a month ago. So it's still incredibly early, but I'm very excited about their store opportunity. And I think it could really take Wayfair to like another level of penetration, because there's just a lot of categories that people are hesitant to do online that have a lot of runway for them. Okay, how's Carvana's balance sheet look like today? Who were the past creditors? Is there a risk of seeing debt increase like it did in another restructuring needed? Okay, so the balance sheet today is in a significantly better position than it was a year and a half ago. But frankly, that's more so because the profitability of the business is so much stronger versus the absolute debt levels. So today, from like an actual like holdco debt perspective, they're about 5 billion in net debt. And I think next year they're going to do 2 billion of EBITDA. So a year from now, that actually is debt that doesn't seem that aggressive. That being said, paying down the debt is a focus for them. If there's one lesson they learned from 2022, it's that although they're happy they took on debt to buy ADESA, they think that they should have just had a bigger cash buffer, so that so frankly, so they don't it's not beneficial for everyone to think you're going bankrupt from a business perspective, from an employee perspective. Like that just is not beneficial. And so they've learned that. They've been recently have raised some equity, is diluted us about 1% as just like a message to show, hey guys, like we're going to get this balance sheet to a very nice position. And so that's not at all a concern for me currently. And the past creditors, it was all public debt. It was all public debt. Oh my God, here we go. Yeah, and all right, so another question here. Once these hit your targets, close to it in 5 years, is your plan to exit entirely and look for other opportunities, or reposition the fund and hold these names, or a bit of both? It's going to depend on what everything else is doing at that time. So as you can imagine, the targets are always moving. So 5 years from now, the target likely is not going to be $750 because it's going to be based off of my view of the future at that point. And so it's going to depend. Yeah, there's really nothing I can say. Like I can say, I hope that I hold it for the next 20 years and it becomes a $1 trillion company. But at the end of the day, everything just Like, I'm not in love with Carvana. If tomorrow it went to $750, I would be selling a significant portion of it because the risk reward just would not be attractive um, relative to other stuff in the portfolio. And so it's going to depend on the risk reward and what is happening with other names at that time. All right, and then last, one more question. I have time for one more question here. Tesla is talking. This is an Uber related question. Tesla's talking a lot about autonomous cars. How do you think autonomous cars will impact Uber over time? Oh, I love this question. Love this question. Okay, so there's this like theory that Tesla, again, I have nothing against Tesla, but there's this theory that Tesla is going to be this leader in autonomy, and the fact that they have millions of cars that people own today is like this advantage that eventually all of us are going to own Teslas, and like when we go to work, we're going to push a button, and all of a sudden our Teslas are going to leave our driveway and start making us passive income. And I mean, it's possible, I guess. You know, anything's possible at some point if you have a longer time horizon. But the reason why that really is not going to be relevant to Uber for quite a while is the need for Uber is very peak. There's peak times, and the peak times for an Uber is also the peak times that people use their cars. And so the idea that all these Tesla drivers that generally actually are like middle to higher income are just not going to need their cars when everyone else needs a car for the most part and are going to be okay with people going in their car, and it addressing a global ride sharing opportunity, in my opinion, is exceptionally low. Um, I would first like to see city buses be replaced by some sort of autonomous vehicle, where that's an obvious thing. They do the same exact route constantly. So when I see that, I would definitely like, I'm obviously watching this very closely, but I would be a little bit more concerned, or not concerned, but like a little bit more like, okay, let's think about how this is going to impact Uber. But ultimately, I think like, let's say Tesla does have the dream state of all their vehicles become autonomous and they just are roaming around picking people up. Um, it's still not going to it's not going to be a big enough fleet to address every use case. And Uber, since they're the leading platform, it will make sense for Tesla to go on Uber. And again, Uber is a marketplace business, so they make 25% of the revenue. The driver gets the 75%. So maybe with Tesla gets 90% and Uber gets 10%. And then maybe it expands the use case of like having on-demand driving services versus buying a car. I really don't see it as I actually think autonomous is going to be a massive positive for Uber, and so it's not a concern to me. But we're at the top of the hour. I did not do a good job predicting the time I would take talking about this. Evidently, I like to ramble. But lastly, I just very excited about the fund today. We've been through a 2 years that has been very challenging from every business perspective. Like the businesses, you know, navigating the environment, dealing with the share price volatility. It's just been a challenging environment, and I think the portfolio today has just proven that these are like really battle-tested businesses that are going to do exceptionally well. And so I think we're like a coiled spring where over the next couple of years, we're going to finally see all the hard work that's happened in the last 2 years is really going to pay off. And so till the end of the year, we have this founders class still open, 50 basis points. I'm going to make money if I make you a lot of money. That's the way it is. And yeah, if you have any interest or have any questions, always happy to chat. Just be ready for me to chat your ear off, I guess. All right, take care, everyone.